Hey everybody, Chris Englebert with Englebert Financial Advisers for the weekly Rotella QCast update. As always, thanks to the crew at Rotella for helping us put this together. We really appreciate it. Well, it's the first part of April, and what do we do around the first part of the month? We do our monthly strategy update, and boy, are things moving fast. Now, one of the things we always start out with is a cartoon, and this is from Hedgeye. And what this cartoon is talking about is what everybody's talking about as far as the inversion of the yield curve. You've heard the major talking heads on many of the financial news networks talking about how the fact that the 2-year Treasury yield briefly went above the 10-year Treasury yield, and that creates what they call an inverted yield curve. Now, one of the things that an inverted yield curve does is it portends a recession. However, you have to get that yield curve to invert for at least 30 to 60 days for it to be a really good indicator. A brief inversion doesn't really mean anything, and we are really not concerned about the inverted yield curve at this point causing a recession. And oh yeah, by the way, there's been numerous studies that show even though if the yield curve inverts for a full 60 days, the recession may not happen until at least a year to 2 years down the road. So we want to keep everybody focused on what's going on. We were really focused on March. We were waiting for the Fed minutes and the Fed meeting to give us some clarity as to what was going to happen with them raising Fed funds rates. We did get it. You can see over on the right-hand side of my chart, the S&P 500. We had a really nice rally, a very vicious rally over a short period of time, only to be stalled this week by another Fed governor making some more hawkish comments. When you hear people say hawkish comments, that means that they're saying that they're going to raise interest rates faster and farther than what's been expected. And all of a sudden, whoa, the brakes got put on that nice rally that we had going. That has to be expected. We again believe, and if you've been following us for a while, we talked about 2022 being brake and gas, bad things happening, market goes down, good things happen, market goes up. So this is not unusual to see the sideways trading, some backing and filling after a 10% decline in the S&P 500. The bigger news is the bond market and the devastation that's been happening in the bond market. So remember, if you buy a 10-year Treasury bond that's paying 2.5% and you hold it for 10 years, you're going to get your coupon payments, you're going to get your principal and interest back after 10 years. But you got to understand the bond market trades daily with tremendous amount of volume. And so what we've circled here is that interest rates really started to go up on the 10-year Treasury at the beginning of the year, and they've now topped 2.6% on the 10-year Treasury, the same level that they were in 2019. However, by interest rates going up so quickly, this has been the worst quarter ever in bond market history. And what means by that is that most bond funds are down 5, 6, 7% for the first quarter, while the S&P 500 was only down about 5% for the first quarter. So what do we do right now? One of the things we think investors have to do is they literally have to lengthen duration or take some of their money that they have in short-term bonds and go out and buy longer-term bonds. We thought the top was in around 2.25%, 2.5%. We've gone a little bit higher. We still think we are near the end of this run or increase in rates than obviously the beginning. So let's talk about going back to the 80s. Some of you subscribe and get our weekly emails. And one of the things that we did a couple of weeks ago was trade talks with Jill Maladrino. If you want to watch that episode again, you can always go to our website and watch all of these episodes and binge watch them if you want. But our thesis right now is that we're going back to the 1980s. And I don't mean parachute pants and Madonna. I mean, in the 1980s, you had higher energy prices, higher interest rates, and higher inflation. And one of the asset classes that did extremely well in the 1980s was small mid-cap stocks. Right now, what's been happening is that over the last 6, 7 years, large cap growth stocks, i.e. tech stocks, have dominated investment returns. We think that's coming to an end, and on a relative strength basis, we see the relative strength in the small mid-cap stocks beginning to build. Watch for positive earnings surprises. Obviously, if you follow the Russell 2000 like we do, there are 2,000 stocks to watch for earnings surprises. But start listening because you're going to be hearing more and more of these companies giving positive earnings surprises. And then once people understand that the place to make money, we think in 2022 is small mid-cap stocks, we think stand back. You can see we did a little technical analysis here. The Russell 2000 broke a downtrend line briefly, got above it. It's pulled back a little bit. We're using this pullback to increase our allocation for our clients. Let's talk about oil prices. We think the top is in near term for oil. It spiked to $130 a barrel. There's literally has been no war premium in the price of oil for literally the last 15 to 20 years. I was at a big investment conference 5 years ago in New York City, and we were talking about energy prices, and one of the oil traders got up and says, I haven't seen a war premium in oil literally, for the last 15 years. There's always been some kind of war premium. Well, guess what? We've got a war premium now. And what a war premium means is that the price of oil is trading artificially high compared to supply because people are afraid of what's going to happen if there's a major conflict that obviously breaks out in Europe and spills over into the Middle East. So we think that that war premium could come out rather quickly on any positive news flow. Oil rig counts. Now, this is something we haven't shown in a while. You can see that the peak in oil rig counts was right around 2014, 2015. And then oil rigs, as far as coming online in the United States, dropped dramatically. But people are wondering why there are such tight energy supplies. And you can see there was a bottom in oil rigs that were out there pumping natural gas and oil out of the ground, literally at the end of 2020. Well, we've seen a consistent increase in oil rigs coming back online. We actually think this oil rig count is going to get back to around 1,000 by the end of the year. That's good news because what's that going to do is obviously increase in supply. So let's sum it up here. March Fed interest rate guidance really sparked a nice rally that was only that turned out to be capped by some hawkish comments by another Fed governor. Historically, April tends to be a very good month. If you look at all of the months in the calendar year, April is one of the best, about the second best month on average after November as far as positive returns in the stock market. So we had a good end to March, nice rally. Let's see if it continues in April after the pullback we're getting right now. Obviously, the 10-year Treasury is over 2.5%, 2.6%. But the point that we want to make for the rest of 2022 is we think you got to watch the small mid-cap stock area. We think there's going to be a lot of positive earning surprises out there. Small mid-cap stocks can raise prices more quickly. Profits flow to the bottom line faster. And oh, by the way, the 1980s were characterized by a lot of mergers and acquisitions out there. Blue Horseshoe likes Anacott Steel. Any of you that watch movies, you'll know what that's from. But the point that we want to make is that we think that there's going to be asset class rotation in 2022, and we're favoring small mid-cap stocks at this time. That's all we have for this week. We'll be back in 2 weeks. We will not be around next week. We'll be back in 2 weeks with another update. Thanks for listening, and we'll talk to you soon.